Hi everyone, this is Jason Baracco of Wall Street for Main Street. I just wanted to do a short video today because I didn't get to address this topic on the Welcome to Dystopia podcast that I did with Eric Dubin last week. I wanted to talk about the oil market. So the oil market got to the mid-50s in price, which was a price that the oil companies could survive, or some of them at least could keep their heads above water. They raised a lot of capital, mostly in equity. They were able to, with their revolving credit facilities, the banks helped them raise shares, equity, to pay off debt. So that was a debt for equity swap, and some suckers were buying shares there. In terms of other things that the banks help the oil companies do to survive, they also put in a lot of extra oil hedges on oil production to try to lock in a higher oil price in the mid-50s. But as you see here on the oilprice.com website, this is a pretty good resource. They have good free articles. They also have pay research that you can do. But they track the WTI crude price and the Brent crude price. We're back, down seriously again. So, if we start heading back to the low 30s, back to the high 20s, maybe even we break below there, the oil companies the ones who are not as hedged are going to be in trouble. Even the ones who are hedged, they're still only going to be able to buy themselves so much time, but it goes back to the banks again. So the banks then are basically keeping some of these oil companies alive. They're not calling in the loans. We've had, I think, 60 oil companies in 2016, over 60 go bankrupt. In 2015, it was a little over 60, but there's a lot more than that are borderline insolvent already, and the banks are just not calling in the loans. I want to talk now about the perspective here, the analysis of the oil market. There's a great video that Ron Paul did a couple days ago, 2 days ago. It's called Mythbuster, the Fed's Role in the Oil Boom and Bust. So that's on the Ron Paul Liberty Report channel. If you're not subscribed to that, it's a pretty solid channel. There's a lot of good information on there with Austrian analysis of current events. And he also had Tom DiLorenzo on there about his new book, The Problem with Socialism. Thomas DiLorenzo will be on hopefully this week, I think on Tuesday, to talk about his book and how a lot of people with Marxism and socialism, communism, they just listen to the definition that they were taught in school and their textbooks and their professors, and they don't understand what's going on. So I'm going to get his opinions on that. He's a really smart guy. He's wrote some very controversial but interesting books about Abraham Lincoln. Maybe we'll talk about that too. So yeah, I think the Federal Reserve, with fractional reserve banking and the Federal Reserve creating, asset bubbles and credit bubbles, they've definitely fueled the shale oil boom. There was a lot of oil companies, even when the oil price was over $100 a barrel, and even $90 a barrel, that were still not making free cash flow and paying out dividends and things like that. They were they were ratcheting up how much debt they were using on their balance sheet, crazy amounts of leverage. So now I want to go to some articles that caught my eye in the oil industry. We'll try to have some oil experts on to talk about potential oil investments. I've said a few weeks ago that if you had bought oil 6 months ago, it was very, very cheap. And then a couple weeks ago, I said if you had some really nice gains in oil stocks, you should think about either taking some or all of the money off the table, because I expected a lot of volatility in the oil market due to the fragility and worsening of the real global economy, and also how a lot of the shale oil companies, when the oil got to the mid-50s again, they started to increase the rigs again, start bringing on wells that were capped that hadn't been producing. They started to produce again. So that was a sign that the top in the oil market was coming back for a number of different reasons. Although long term, once a lot of these oil producers do go bust and a lot of oil production does come offline, there was so much money in capex cuts, over $200 billion. Actually, there's an article saying here, Goldman Sachs. I'm kind of going out of order. Okay, so let me just go through these articles first. So Robert Rapier has an interesting article. I got this from Dan Steffens of Energy Prospectus Group. We've had him on a bunch of times. He's out of Houston, Texas, also in Dallas. He covers the oil market extensively, 30 years experience working in the energy industry. Good contacts, too. He's picked out a lot of winning energy stocks. Robert Rapier is another oil expert, over 20 years, I think over 30 years now experience. It was over 20 when I met him initially 4 or 5 years ago. So he covers the oil market, talking about the oil market since 2016, the beginning of this year, has been one of the outstanding performers compared to the other industries. Only I think the utility sector has outperformed oil and energy. But in terms of looking at the companies, even at mid-50s oil guys, the oil companies are just announcing earnings lately. A lot of them are not generating free cash flow. Here's a list. I'll put a link to this article. A lot of these mid-tier and independent oil companies are not generating free cash flow at mid-50s oil. On this list, really, only Apache is generating free cash flow, and the other one is EOG. Barely eked out a small amount of free cash flow. So there's really very little, and I think Devon. So there's very little companies that are generating free cash flow even at mid-50s oil because they're just in full cost-cutting mode. They're trying to fix their balance sheets. There are some good investing opportunities here. He thinks that Hess is pretty undervalued and that the company's balance sheet is not overly leveraged with debt, so they can ride out a lower oil price even though they're not generating free cash flow quite yet. So in terms of the rest of the stuff, the oil market, let's look at some of the stories. Seeking Alpha, I will put a link to this, talking about going through some of the earnings releases of some of the larger oil companies. No place for super majors to hide. ExxonMobil's lowest quarterly profit since 1999. Chevron's third straight loss for its longest slump in 27 years. Normally this would say that this is the bottoming of the market, but we still have so many shale oil producers trying to bring on new oil that would make things that would make me a little wary that we haven't fully touched the bottom yet. The oil market's going to be very volatile and range bound for at least another couple years, I would say, unless a lot of oil producers go bankrupt and a lot of production comes offline. In terms of the rest of this blurb here, going through some articles, Shell had really bad earnings, so did BP. Refining margins will get worse, which is refining margins, the refining parts of the integrated, so the larger companies like Chevron, Exxon, Shell, these guys have, besides just exploration and production for oil and natural gas, they also refine a lot of oil. They were actually making really good money on refining oil into distillates and other things at a lower oil price because their inputs were cheaper. One analyst says 20-year commodities bear market super cycle now, $30 to $60 oil for at least the next decade. I disagree with that for a number of different reasons. I think if enough producers go bankrupt, he's going to be proven wrong. It really just depends on if the large banks that are holding these oil loans and central banks like the Federal Reserve want to keep some of these zombie oil companies alive. So not only, guys, do we have zombie banks now, and we have different degrees of zombie banks. A listener made an interesting comment on one of my videos. I think the European banking crisis video. If you're listening to this, you'll know who you are. He was asking, well, what's the difference between the Japanese central bank what's the difference between the zombie Japanese banks and European banks? And, well, the European banks got into the over-the-counter derivatives market way more than the Japanese banks did. So there's different degrees of zombie banks. The American banks and Western European banks in England and Western Europe got crazy into the over-the-counter derivatives market in the 70s, 80s, 90s, and 2000s. The Japanese banks just had, bad Japanese loans, mostly. Most of their loans were from bad Japanese corporations. They weren't crazy into the derivatives market as much as American and European banks were. So hopefully that answers your question. Finally, I've got a couple David Stockman articles I just want to drive you guys through. Okay, Robert Rapier had one more article about how he thinks, there's going to be good, the real demand for oil market is still going to be pretty strong. So the lower the oil price goes, that eventually there will be strong demand for oil. I think he will be right in the long term. In the short term, there's going to be a lot more volatility and pain. So it just depends what valuations you're getting companies at. Obviously, you want to look at balance sheets. You want to look at how much debt does the oil company have and when is it due. The one thing the oil companies are going to have to do, and the gold and silver miners have had to do this last couple years, the oil companies are not doing this right now, is you see stupid articles like this come out and say that Pioneer Natural Resources boasts a $2 per barrel production cost. Okay, the oil, that's like the cash cost for mining. That doesn't count the majority of the costs that are going into bringing the oil out of the ground. That's just the cash cost or lifting cost. That doesn't include transportation costs, their cost of capital, their exploration budget to replace reserves. So that's probably not even 30% of their total costs is at $2 per barrel production cost. The oil industry is going to have to add the all-in sustaining costs. Like the gold and silver miners have had to, because these companies have not been totally honest with what their real costs are. You could painstakingly, I might add, go and run the financials and figure out their costs, but it takes more than 30 minutes to run the costs and check the numbers for each oil company to even have a ballpark number for what their costs are in many cases. So, the oil industry is going to have to reform and give more transparency to what their all-in sustaining costs are, show all the different costs line item by line item, transportation costs, capital costs, all these different things. Lastly, let's get to the David Stockman's Contra Corner. Now, these are articles I searched in the oil market that he's had since December 27th of 2014. Basically, he said since oil dropped below $70 a barrel, there's over $1 trillion in oil projects that will be cut. Let's keep going again. It said OPEC revenues have dropped below $1 trillion for the first time since 2010. OPEC has gained more market share, but they haven't strangled or killed all the shale oil companies that they thought they would. They have gotten a lot of higher cost producers in deep water and oil sands to either slow production or shut off temporarily. But I think OPEC thought that they would have for sure bankrupted most of the shale oil companies by now. So they have gained market share just not from all the people that they thought they would. And obviously, they've had to use a lot of debt. Russia and Saudi Arabia have had to use an enormous amount of debt in order to implement this strategy to regain market share. Was it worth it for them long term? I don't know. It's still, we don't fully know the answers to that yet. But, this is what happens when you have large banks doing fractional reserve banking, where they can, change their accounting and they don't have to declare losses, and they can, play games with their accounting. And the Federal Reserve tells the banks that not to call in loans on bad oil and energy companies. So you get games like this with central banks and accounting games. David Stockman's articles also say that busted value of world's proven oil reserves, over $119 trillion in oil reserves, will have to be written off. Obviously, that's a lot of assets that are going to be written down. So the balance sheets of these oil companies are still going to be affected going forward. That's going to screw up their debt to equity ratios. It's going to screw up their debt to cash flow ratios. It's going to make the bankers even more scared of the things that are coming. So we have so many different bubbles out there, black swans, that could potentially, wreak enormous havoc. The oil market is just such a large market. It's definitely a market that people need to pay attention to. A lot of gold and silver bugs don't really pay attention to it, but it's very important. I think that they should. The oil price and the oil market are very important. It's such an enormous market. The revenues of entire governments, whether Saudi Arabia, Russia, Venezuela, Nigeria, Mexico to a large extent, a lot of their revenues are based on high oil prices. And that's one of the main reasons why the Venezuelan government is collapsing. When the oil price was much higher, Chavez and Maduro and the other puppets there were able to get away with their ridiculous corruption and socialism and cronyism and all this stuff. So we've had a 1.3 trillion. Finally, we've had a 1.3 trillion wipeout of market cap in oil companies. So it's probably going to end up being more than that before all the pain is over. We are going to have mergers and acquisitions. Right now, though, guys, if you're a trader in the oil market, I would look for volatility trades up and down. I think the volatility is going to be enormous in the oil markets. I said this, I think, on my X22 report interview when I was asked about the oil market. I said, every 2 to 3 months, the oil price could go up $20, down $20, and it could just really cause havoc for a lot of people. So I think the oil market's going to be a very wide trading range with a lot of volatility until the central banks stop giving the large banks credit to make these crazy amounts of loans to oil companies, and until the oil companies have their loans called in by the large banks. And to a large extent, it's not happening. They're just in extend and pretend mode. So not only now, guys, do we have zombie banks in many different countries, we now essentially have zombie oil companies as well. So that's it for today for the most part. In terms of the interviews that are coming up next week, I have Thomas Di Lorenzo. Like I said, he's an Austrian school economist. He's written some amazing books in the past about Abraham Lincoln. His new book is The Problem with Socialism. Mo has Jerry Robinson this week. As of right now, he's been on a past guest many times. And on Friday, as of right now, I have Dave Kranzler back on. So have a great week, guys. There's going to be a lot of volatility in the oil market. If you're interested in consulting work and setting up volatility trades, I think those are going to be profitable either on oil index like the USO or oil sector services ETFs or oil producers ETFs. I think there's going to be a lot of volatility going forward. So I don't think, unless you're a long-term investor and you're going to average down into your positions, it's not really a good time right now to buy a lot of oil stocks. If you already have profits in oil stocks that you bought, 6 to 8 months ago, you should be taking some money off the table if you haven't already done so. Okay, guys, that's it for right now.